to Growing the F Up, Life Lessons with Liz. Today we are going to talk about banking basics. We're going to talk about the very specific basics that go along with what kind of accounts there are, what the differences are between debit and credit cards, what the differences are between having cash in your hand or using a peer-to-peer banking type situation. Just the very basics of banking, how it works, and the different options that are available to you and what they all mean. So first of all, we're going to talk about the different kinds of accounts. If you walked into a bank today or you logged into a banking app and you were trying to figure out what kind of account you needed for you, what do those look like? So there's two basic things that are typical for most people who have different kinds of accounting or accounts at banks. There's a checking account and there's a savings account. They're used for two separate purposes. A lot of times now they're combined together. It's funny because the checking and savings, those terms were actually brought back when I was younger, and when my parents were paying bills and banking, because it talked about it was a specific kind of way you pulled money out of those accounts. So you had your savings accounts. We'll start with that. So savings accounts are basically money that accounts that you put money into and leave it. So you have the ability to pull those back out, but they're not something that we are constantly pulling money out of. So those are things that we have money, we want to hold on to it for a longer period of time. It doesn't necessarily mean, a retirement savings. If you're 22 years old, you might not necessarily put a retirement savings in that account, but savings just meaning you're not using it regularly. You're not pulling money out of it. So you're putting money in and you're leaving it there. Now on the other side of that, other accounts that you would see are typically called checking accounts. Now, those accounts are accounts where you put money in and you're regularly pulling money out. And you can pull that out a variety of different ways, but the basic notion of it is that you're putting money in and regularly putting money out. So money regularly goes in, regularly comes out, back and forth, back and forth. Now, they were called checking accounts when people were writing checks. Not many of us are writing checks any longer, but it basically meant that I could have money in that account. I could go to any establishment, I could pay bills, I could go to a store, and I could write a check, and that was a check saying, I want you to pull money out of this account. And so it gave us the ability to do that. Then they added to that what we used to call check cards. A lot of times now they're called debit cards because, again, nobody writes checks anymore. So they're attached to that then became a check card or a debit card. So that's a card that you have that allows you to pull money out of that checking account. So the differences between the two, again, checking accounts are accounts that you put money in and regularly pull money out. So you can use that to, maybe your paycheck goes in and then you can use it to pay your bills. You can use it to, order Starbucks. You can get gas with it. You can attach it to other accounts to be able to do other things with, and we'll talk a little bit more about that later, about like peer-to-peer and how you can pay people with different things like that. But the basics of it are savings account, you put money in, you leave it there until you need it for a big purchase. Maybe you're trying to save for a car, maybe you just want to make sure you have some cash put away in case an emergency happens. So those are put money in, leave it there. Checking accounts, put money in, use it regularly. So a lot of in and out, in and out, in and out. And those are what most of us use for our regular everyday spending. So your check goes in there and then you have the ability to be able to spend from there. Another big difference between checking and savings accounts. When you get a checking account, there's lots of different kinds of checking accounts. So if you go into a bank and you're asking about different kinds of checking accounts, a couple things you want to make sure you're talking about. One of them, you don't want to be paying fees for things that you don't need to be paying fees for. Most banks at this point have checking accounts that are fee-free. But however, there's some restrictions that usually go along with that. Sometimes you can get a student account if you're still a student or you're under a certain age, and that will eliminate fees. Other accounts require you to have a certain balance regularly in your account, or they require that you spend a certain amount of money to not have fees. So make sure you're checking those things when you're opening up those accounts. Make sure that what makes sense. Some of them don't charge you fees if you direct deposit a certain amount every month. If you don't get that much pay every month, that's a great feature for someone who might have more in pay than you do, but it's not for you. So keeping an eye on those. Fees are attached a lot of times to checking accounts. So you want to make sure you're finding accounts that make sense for how much money you're having in there, how much spending that you're doing with it, how much pay is going in, whether you have the option for direct deposit, those kinds of things. Again, like if you're an entrepreneur and you work for yourself, maybe direct deposit isn't something that works for you, so that is not a benefit for you. So making sure you're checking on those things. Savings, on the other hand, a lot of times, depending on the savings account, you can get paid for keeping your money in that account. So it's called interest. So basically, they do a calculation of how much money you have in the bank. Sometimes some of them are daily, some of them are monthly, but it gives that balance, that average balance that you have, and it pays you 1%, 0.5%. Some of them are bigger. You might, if you got lots of money in there, a lot of times they like to pay you more for the money, keeping lots of money in there. But that's another big difference between savings account. Most of the time, checking account, you are paying to keep your money in there because you have easy access to it. Savings account, they're paying you to keep your money there because you're not messing with it, and they like to make money off of your money. We will get into more specifics about different kinds of savings accounts and interest and all of those things in another episode. But for today, just the basics. Savings, money we put in, keep there. Sometimes we get paid to keep it there. Checking, money we put in and move out regularly. Sometimes we have to pay to do that. Most times you shouldn't have to pay to do that. Make sure you're watching what you're doing so that you can make sure you're not paying someone to mess with your own money. There are options out there that don't include that. Now, we talked about checking accounts having check cards. Like I said, they used to be called check cards because it was basically you use the card instead of a check. We know now that is not really the case for most things. Now they call them a debit card. So the difference is now, let's talk about the difference between a debit card and a credit card. Two different things. They look the same, but two different things. So a debit card is specifically linked to an account that has cash in it. Now, that money could be direct deposit money. You could have got a check from your grandma for your birthday and you put that in the bank. You could have a big pile of cash from tips that you made and you deposited that into an account. However the money got there, once it gets there, a debit card allows you to have digital access to that money wherever you go. Most of them have a Visa or a MasterCard logo on them, so as long as they have a Visa or a MasterCard logo, they're accepted in most places. So you can use them then to buy things online, you can swipe it at the gas station, you can swipe it at the grocery store, you can swipe it at Target, whatever you want to do. But debit specifically talks about a kind of card that is attached specifically to an account that has cash in it. So if you have $250 in an account and you go to Target and swipe that card and you say, I want to spend $120, that account then tells Target, yep, they got that much money in there. That money comes out. So then now you have that $120 come out of that account, so you have that less, and Target is paid with that. Now the difference between that and a credit card, so a credit card is a little bit different in that a credit card is money that you spend that you don't actually have. So a credit card allows you to spend money that you don't have yet with the promise that you will pay it to them later. So you take that card to Target, you swipe that card, $120. You then get a statement later from that credit card company saying, hey, we gave Target $120 for you. You need to give us that $120 now. Most times, there's interest attached to that. So they say to you, hey, we gave Target $120 from you 3 weeks ago. Now we're going to send you a bill that says, we gave them that $120 because we gave it to them and you didn't have that money ahead of time. Now you have to pay us $125 in order for that to continue to work. Now also on that credit card, there are what they call credit limits. So basically that means there's a certain amount that you're allowed to spend before they stop you from spending. On the debit, of course, you're allowed to spend however much is in that account that it's attached to. Credit, different, but there's also interest attached to it. again, we will have another episode specific to credit cards, how we get credit cards, how we use credit cards, what kind of interest ends up with credit cards, and how those things work. But I just want to make sure you understand the very specific difference between a debit card. A debit card is attached to an account that has cash in it that you spend, that you have the money now, you've given it to someone else. You just do it in a digital way, online or swiping. Credit card, you don't have the money right now, so someone is giving that money for you, and then you're going to have to pay them back later. Most times more than what you spent. So now that we know the difference between debit cards and credit cards, I want to talk to you for just a minute about the difference in kinds of credit cards that are out there. Again, I'm not going to get into really specifics about credit ratings and interest charges. Again, we're going to talk about the basics, but let's break down that credit card setup into two different categories. So you have one credit card setup, which would be considered a standard credit card. Again, it has that Visa, MasterCard logo. You might have also heard of Discover or American Express. These are specific companies who give you a specific amount of money that you can spend without having it, with the promise that you're going to pay that money back to them. Now, another kind of card that I'm sure you've seen out there while you're out shopping or out at the grocery or whatever the case is, and those are called store credit cards. So those are a little bit different. You get them the same way, basically. You have to have a credit score. You have to tell them how much money you make so they can get an idea of how much money they should give you. But store credit cards are only available, that credit is only available at the store that you're sitting in. So like if you have a Visa or you get an American Express card, you can use that at McDonald's, the grocery store, the gas station. That same card can be used at all those different places. If you walk into a Home Depot and you get a Home Depot card, you can only spend that money on that card at a Home Depot. So there's reasons why people do that. So sometimes they do promotions on those kinds of cards, and so it makes sense. Oh, I can get 6 months to pay this off with no interest as long as I spend that money at Home Depot. If you're doing a house project, that makes sense. If you need to buy a new appliance, that makes sense. But you can have that money in your wallet. So you have that Home Depot card. I'm just using it as an example. That Home Depot card can be in your wallet. And that Home Depot card can say you can spend $1,000 at Home Depot. But if you're stranded on the side of the road and you need to buy groceries, or you need to buy gas, if you need to buy gas, you can't use your Home Depot card for that. So two separate things. They work similar, but I want to make sure you understand. If you walk into Old Navy and they ask you if you want an Old Navy card, and they tell you they can give you a $400 limit on an Old Navy card, that means the only money that you can spend on that card is at Old Navy. If you need $400 worth of Old Navy clothes, by all means, do what you have to do. But if you're expecting that you're going to be able to buy groceries or gas or things like that with it, not what it's there for. So you have your standard credit cards and you have your store credit cards. Separate things. Standard credit cards you can use anywhere as long as they have a Visa or MasterCard logo. And you can usually see on the outside of retailers whether they have, take Visa, MasterCard, Discover, American Express. Discover and American Express are not accepted at as many locations. It has to do with the fees that they charge the retailers themselves. But again, we'll get into a little bit more specifics about that later. But then you can use them at a variety of places, where store credit cards are very specific to that store. Now, there are some cards that are what we would consider store credit cards that you can't use everywhere, don't have a backing of like a Visa or a MasterCard, but you can use them at a variety of places. There's some car care credit cards. Like if you walk into a Midas or a Meineke and you have a car repair that you need to do, and they might offer you financing for that. Some of those, I could use it at that place that I got it from, and then there are other car repair places across the country that use that as well. So again, it's all about knowing what it is you're looking for, knowing what you need, and then recognizing, can I use this all the time, or can I only use this in these specific situations? So we've had a lot of talk about cards. Cards are easy, convenient to be used online, to be used in all different retail stores. It's easy to be able to have that. Now, one thing I will caution you about is its ease of use, the ability to use that card anywhere, and be able to, have it digitally take care of things is a great convenience. However, if we're not careful, we can let our money run away from us because we swipe and we don't remember that we swiped, or whatever the case might be, or we swiped and we thought we swiped 3 or 4 times, and then all of a sudden we turn around and we're like, oh no, I ended up spending more than I thought I was going to. Of course, along with those checking and savings accounts, there is what they call overdraft fees, which basically means, hey, you didn't have enough money there, but we paid for that. You have to pay us the fee because we paid for that. So we want to be cautious about that. And one of the ways we can help with that is by putting together a budget. We will talk more. I will have an entire series about budgeting and how to budget well for yourself, but it's really about making sure that we're telling our money where to go rather than our money telling us where to go. So making sure we're cautious about using our cards in those kinds of situations. Another way that you can use your card is to attach it to a peer-to-peer banking system. This can be ones you might have heard of: Venmo, Cash App, Google Wallet, those kinds of things. What it basically does is it says, I'm attaching my checking account through this card to this other application. And so other people have that application, and they can attach their checking account with their card to their application, and then you can send money back and forth. It eliminates you having to pay fees to do that. It eliminates you having to stop at ATMs to get cash out for your friends. And so it allows you to quickly be able to move that money back and forth. Some of those peer-to-peer accounts will keep money in the account, and you can just pull money from that account. So say your friend sends you $20 because they owe you $20 for their part of lunch, and then that money will just sit in that account waiting in that app's account, and then you can send $10 to your buddy because their kid wanted to sell Girl Scout cookies, or whatever the case is. You can send that as well. And so sometimes you'll need then to transfer that money back to your checking account so you can use your regular check card to be able to pay for that. So just keep that in mind, that when somebody sends you that. Now, Google Wallet is not that way. Google Wallet sends it directly to your checking account or your savings account, whatever account you have attached to it. But accounts like Venmo and Cash App, those are ones where you have to then transfer that money into your actual checking account, or only be able to use that account to be able to pay those, to be able to spend that money as well. So just keep those in mind. It doesn't automatically show up there. So you have to keep in mind 2 different accounts in that situation. So again, just making sure that we're paying attention to how we use our cards so that we can make sure that we're only using the money that we expect that we're using and not get out of control with it. Okay, so what did we learn today? We learned about different kinds of bank accounts that we can get, what works for what, making sure we're using those accounts correctly, making sure we're getting paid for keeping money in our accounts, making sure we're not paying for keeping other money in our accounts. We learned the difference between debit and credit cards, and recognizing whether you owe somebody something or whether it's coming out of your own money in the first place, and how we use those cards as well. Again, these are just some real basic things about banking that I want to make sure you understand. We will talk more in depth about each of these items moving forward in our series, but I just wanted to make sure you had that good basis so you knew what kind of accounts are out there for you and how to use those kinds of accounts, and what it means when someone says, are you using debit or credit? It's an important thing to know, and so I want to make sure that you understood what they were asking and how that works for you. If you like what we're doing here, make sure you like and subscribe, and make sure you hit that notification bell. Just want to make sure that you can see anything new that we are coming out with. I'll see you next time.